Cap rate compression and price appreciation are making it very difficult to crack into some of the nation's largest top-performing markets. So is it time to start looking at some of the nation's smaller markets? Maybe so. We're going to discuss some of the top-performing secondary markets in today's edition of Apartment Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett. And Greg, in recent years, there's been so much attention on some of these large top-performing markets that I think now we've seen a little bit more discussion about some smaller markets now that a lot of folks are getting priced out of the big places.
There are folks who are looking at these secondary markets now, and not to be total buzzkill, though. I mean, there certainly is a block of the investor community who is never going to look at some of these markets that are really small, and they can be really volatile. And also, I mean, there are spots where data is not all that plentiful. And so it's to some degree hard to get a handle on what's going on.
But that's what we're here for, right?
Well, that's what we're here for, is a bigger existential question that I want to deal with. But sure, we can provide some information.
Let's do that. Let's look at the top 5 performing secondary markets at the midpoint of 2013. Now, let me briefly point out that everybody defines secondary differently in different ways. For us, we define major markets as the top 50 in terms of their total number of apartments, and we define secondary as the other markets that fill out the top 100. These are markets with 25,000 to 85,000 apartment units. And now, looking at apartment performance over the past year, there are 5 very clear standouts. The same 5 rank for the top 5 for rent growth among secondary markets, also the same 5 who rank top 5 for apartment revenue growth, and all 5 of these markets also made the top 10, regardless of size, for those 2 measurements as well. And so with that introduction, Greg, start us off with a countdown at number 5.
Number 5 spot is Honolulu, Hawaii, the spot where everybody on our staff is volunteering to go take a closer look at it and see what's going on.
It's a hard-working bunch.
It is a hard-working bunch. What we see there is that Honolulu has experienced 6.1% year-over-year revenue growth. Occupancy is tight, as it pretty much always is, right now at 97.4%, down, but only 10 basis points year-over-year. All the revenue growth then is coming on the pricing side, with same-store rents for new leases jumping 6.2% annually. Even with these numbers, though, I just don't know that a lot of folks are going to jump into that Honolulu market. It's different from a lot of other places across the country, and particularly in terms of the nicer quality rental product. It just tends to be condos that are being offered for lease by individuals.
So maybe a vacation spot, but not a place to invest in apartments. Number 4 on the list, Sarasota, Bradenton, Florida, just south of Tampa Bay. Revenues here jumped 6.6% year over year. Occupancy came in at 96.3%, up 80 basis points annually. Rents were up 5.8% year over year, so much better numbers than what we're seeing in the market to the north there in Tampa Bay. And this one continues to far exceed our expectations for this market. And just like, by the way, another market that we're going to discuss here in a little bit. And it's tough to see, judging from the underlying fundamentals, just how this market has performed as well as it has. Now, they are seeing some job growth of late. I'm sure that's helping in the apartment demand picture. But this market was really hit hard by the recession. And when you look at the job count where it was prior to the recession to where it is now, there is still a ton of runway left. And so this is not one that we would bet heavy on going forward.
And let's flip that now. In our top 5 list, the one that actually we probably would bet the heaviest on that this is sustainable is in the number 3 spot. That is Corpus Christi, Texas. What we see are that revenues have jumped 6.9% year over year. That's largely due to an annual rent hike of 6.3%. Occupancy up 60 basis points, now at 96.9%. You know, the story there on this one is it's Texas. And so really all the Texas markets are doing really, really well. Corpus is a port city as well as a tourism center, and has picked up some momentum related to the booming energy sector and some solid sustainable growth, certainly in Corpus Christi.
And number 2 on our countdown is another market that benefits from geography, Santa Rosa, Petaluma, California. Revenues up 7.5% year over year. Rents jumped 6.8%, and occupancy increased 70 basis points to a super tight 98.2%. Now, this market is part of the Bay Area of California. It's northwest of San Francisco and Oakland. So this is a market that's just riding the wave of the whole Bay Area boom. Big job growth has extended out to this part of the Bay Area. In fact, the job base grew 3% over the past year, one of the best clips in the country, and obviously apartment market is reaping the benefits.
And in the number 1 spot, surprising to us, if you had looked at a year ago what we were expecting for this one, we certainly would have not put it up in that category, is Fort Myers, Naples, Florida. Revenues are up 9.5% on an annual basis, strongest in these smaller markets, and in fact, stronger than any of the big markets across the country as well, putting it at the top of the list for the nation's 100 biggest markets. What we've seen is rent growth of 7% over the past year and occupancy up by 250 basis points to a rate of 96.4%. Fort Myers, Naples is just south of the Sarasota Bradenton area, as you've talked about as well. And same story here. Improving job growth. You would expect to see demand. You would expect to see occupancy going up. That rent growth number, though, is just pretty shocking and really unlikely to be sustainable.
Clearly. And Greg, we're short on time, but since this list has been all about backward-looking performance, I do want to talk briefly on some other markets that we like going forward. Corpus Christi and Santa Rosa are 2 that probably could continue to do well over the next few years. We also really like 2 South Carolina markets, Greenville and Charleston. Both areas have great demographics and some attractive underlying fundamentals. Oklahoma City, another hotspot, booming economy, and yet despite its proximity to Texas, surprisingly not a lot of apartment construction quite yet. And if we had to pick some markets in the Midwest and the Northeast, I would probably pinpoint Madison, Wisconsin, and Albany, New York, both solid bets. And so with that, that wraps up our discussion on secondary markets. So until next time, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics.
Want more? Go deeper with MPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, MPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.